outcome-driven versus process-driven mindsets in trading, and how each one shapes the equity curve. Two traders can follow the same system, take the same setups, and still end up with completely different equity curves. Outcome-driven and process-driven mindsets represent two completely different ways of approaching trading, and each one directly shapes both the equity curve and the trader's mental state. The difference shows up not in theory, but in daily decisions and long-term results. Outcome-driven mindset. Focusing on this trade and this month. With an outcome-driven mindset, attention stays locked on short-term results. Every trade feels critical, every week feels like a test, and every month has to hit a specific number. Once that mindset takes over, behavior starts to shift in predictable ways. Performance gets judged based on the last 2 or 3 trades instead of a meaningful sample. Strategies changed quickly after a few losses because recent results look bad, and constant pressure builds to reach a specific profit number. That pressure often pushes risk higher and lowers the quality filter on setups. The equity curve mirrors this behavior clearly, turning jagged and uneven with sharp profit spikes followed by deep drawdowns where short bursts of gains get erased by heavy losses. Over time, the account starts to resemble random fluctuation rather than a controlled upward trend. Inside this mindset, every loss feels personal and every win feels like a validation, and that emotional swing gradually wears down decision quality. Process-driven mindset, focusing on how the game gets played, not on winning this hand. With a process-driven mindset, success gets measured in a different way. The focus shifts away from outcomes and toward execution, like following the system, managing risk correctly, and taking only qualified setups. Individual trade results still matter, but they no longer drive decisions. What carries real weight is how well the process gets executed across a series of trades. This mindset shows up clearly in behavior. Wins and losses get accepted as a natural part of statistical distribution. Systems get evaluated over large samples, like 50 or 100 trades instead of the last few. Attention stays fixed on controllable factors such as time discipline, risk management, and trade handling, rather than on the outcome of a single position. The equity curve reflects this approach as well, appearing smooth and more stable with fewer sharp swings and more controlled drawdowns. Instead of explosive jumps, growth develops slowly but with consistent timing. Within this mindset, a loss turns into feedback about the process, shifting the key question from whether the results fit within the system's normal distribution to points to a deviation from the plan. How these mindsets change daily trading decisions. The difference between these two mindsets becomes most visible in everyday trading situations. After 3 consecutive losses, an outcome-driven reaction usually sounds like the system no longer works and needs to change, which often leads to switching setups, jumping between timeframes, or increasing position size in an attempt to recover losses faster. A process-driven response moves in a very different direction by asking whether those losses fall within the system's normal statistical range and whether execution followed the plan. When the answers stay yes, trading continues calmly, and when they do not, attention shifts toward fixing the process instead of forcing results. The same contrast shows up when a trade moves into profit, where an outcome-driven trader often exits early, even if that decision damages the system's risk-to-reward logic, while a process-driven trader sticks to predefined targets and management rules, accepting the loss of some unrealized profit because long-term execution quality matters more than the result of a single trade. How each mindset affects risk and position sizing. Outcome-driven mindset often pushes risk higher at the worst moments, especially after losing streaks or when trade feels like a special opportunity that has to work. As profit targets start to feel close, filtering rules loosen and pressure builds to force one more trade just to hit a number. Process-driven mindset works in the opposite direction, by treating risk as a fixed part of the system rather than an emotional lever. When drawdown reaches a predefined limit, position size gets cut back or trading pauses completely, even if attractive setups appear on the chart. Because of this difference, the equity curve under a process-driven mindset tends to look controlled, with a steady and moderate slope, while an outcome-driven equity curve often turns into steep waves and can wipe out large portions of profit in a short time. How to shift from outcome-driven to process-driven mindset. Shifting from an outcome-driven mindset to a process-driven one starts with building the change directly into the trading system. That begins by defining process-based goals instead of profit-only targets, such as aiming to execute 90% of trades according to the written plan during the week, or committing to never entering a trade without completing the checklist. A trading journal with 2 clear columns supports this shift. When one column tracks financial results like wins, losses, and percentages, as well as R, and the other scores process execution on a simple scale, such as 0 to 10. This structure allows a losing trade to score high for execution, while a winning trade can still expose poor discipline. Over time, goal setting also needs to move away from daily or weekly targets and toward longer horizons, such as 3 to 6 months, which pulls attention away from short-term noise in the equity curve and redirects it toward the broader trend. In highly volatile markets, which mindset has kept your trading more stable? Outcome-driven or process-driven? And why is that?